Hello and welcome back to the ComLucro channel. In today's video, we break down breaker blocks, one of the most powerful tools for understanding how institutional price delivery unfolds within market structure. In this chapter of our Smart Money Concepts course, you will learn how breaker blocks form, how to identify them clearly across multiple timeframes, and why they shift from demand to supply or from supply to demand. We will also cover the exact criteria that transform a simple candle formation into a high-quality trading opportunity. By the end, you will be able to anticipate potential reversals and position yourself with confidence, aligned with true institutional order flow. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let us begin with the foundation. What is the definition of a breaker block? A breaker block is a previously failed order block that transforms into a key supply or demand zone on the price chart. This happens when an order block is broken in the opposite direction, shifting its role from supply to demand or from demand to supply. In practice, a breaker block helps mitigate positions and often becomes an area where traders add to their positions. There is also an important principle to keep in mind. Whenever price breaks through a key demand or supply zone without showing respect, that zone automatically shifts its characteristic. A supply zone becomes demand, and a demand zone becomes supply. The same principle applies to order blocks. The market may ignore the supply or demand of an order block for several reasons, such as shifts in market structure, overvalued or oversold conditions, interaction with higher time frame key areas, major economic news releases, or other fundamental drivers. When a valid demand order block fails to reject the price, and the market breaks through it to the downside, it turns into a supply level known as a breaker block. In this situation, we expect the price to reject that zone and continue pushing lower. Now, let us look at the psychology behind the breaker block and understand how it works. Imagine a bullish break of structure forming above the last high with inefficiency. This movement creates a valid order block tied to that break of structure, giving traders a reason to look for long entries. However, if the price later shifts market structure by pushing and closing below the most recent low, the directional bias flips to bearish. When this happens, the original demand level loses its strength and turns into a supply level as the price breaks through the order block to the downside. The psychology behind the breaker block is straightforward. Traders who went long from the original order block now find themselves trapped. They wait for price to return to break even so they can exit without taking a loss. When many long positions close in the same zone, a surge of sell orders enters the market, creating strong downward momentum. At the same time, retail traders often see the previous structure shift as a trend line breakout. They expect the price to pull back for confirmation, which leads them to look for short setups at the retest area, also known as the breaker block. Many traders will short this zone because they view it as a key supply area. Combined, these actions turn the breaker block into a clearly defined supply zone with a high probability of generating short opportunities and driving price reversals. One more point to note is that breaker blocks tend to be most effective when the market is trending strongly in either direction with shallow pullbacks, and when price is not respecting premium or discount supply and demand levels along the way. Now let us move to the next topic and look at how breaker blocks are identified from a candlestick perspective. In a bullish scenario, a candlestick-based breaker block appears when an area fails to reject the price. This is represented by the last selling candle that forms just before a strong upside move. That candle usually breaks below or sweeps the liquidity of the lowest point of the previous candle. In a bullish diagram, we would highlight this red candle as the breaker block because it is the final bearish candle before price launches into a sharp upward movement after sweeping the previous low. A similar idea applies in the second candle sequence. Here, the breaker block is the last small bullish candle that forms right before another sharp upside move, breaking below or sweeping the liquidity of the previous candle's low. These same principles hold true in bearish markets as well. It is also important to remember that these concepts work across different time frames and on any price action-based chart. Make sure to follow the video closely until the end. In the next section, we will explore the criteria and rules for identifying valid breaker blocks and review the scenarios that turn a breaker block into a high probability entry area for strong trading setups. To identify valid breaker blocks and use them effectively, we need to consider several criteria and rules. The first point is the clearing of buy-side or sell-side liquidity. For a breaker block to be valid, the price must take out a clear area of liquidity before forming a market structure shift. Here is an important pro tip. When identifying a valid order block, the price must break and close above or below the recent swing high or low to confirm a proper break of structure. However, this condition does not apply to breaker blocks. When identifying a breaker block, the candle body does not need to close above or below the recent swing point. The second rule states that in a bullish scenario, the sharp movement should create a higher high, and in a bearish scenario, it should create a lower low. This helps filter out isolated candle spikes and avoids relying on manipulated or emotionally driven moves before a market structure shift forms. The third rule highlights that once buy-side or sell-side liquidity has been taken out, the price must begin to reverse its direction. The fourth rule states that a breaker block is only considered valid if the price breaks and closes below or above the breaker block with the body of the candle. A simple penetration with a shadow or wick is not sufficient. Rule number 5 explains that breaker blocks are treated as one-time use zones. This means we focus on the trading opportunity when the price first returns to the breaker block. Once the area has been mitigated, it is no longer considered an active zone for future setups. To integrate all the criteria and rules for identifying valid breaker blocks, let us review a clear chart example. First, we have a swing high followed by a swing low. Then we see a strong upward push that breaks and closes above the previous swing high. This movement establishes a valid order block, showing strong demand. Once the buy-side liquidity is cleared, the market quickly reverses direction after forming a new higher high and begins to push downward. Eventually, the price breaks and closes below the low of the last bearish candle, confirming a clear shift in market structure. At this point, the zone becomes a valid bearish breaker block, indicating that buyers positioned in this area have been stopped out. Since the market has shown a bearish structure shift and a former demand zone has now turned into supply, we expect the price to reject this breaker block and continue moving downward. As shown, the price first pulls back upward and pauses briefly inside the breaker block. After building up additional buy orders, it gains momentum and resumes its move to the downside. Moving forward, the first high-quality type of breaker block with strong probability occurs when it forms immediately after a liquidity sweep. As mentioned earlier, a liquidity sweep is created by a single candle that clears liquidity above or below a previous high or low. This pattern often appears right before a sharp and meaningful reversal. In this situation, we anticipate a quick price reversal following the sweep. Once liquidity is cleared, the price typically returns to the area of the most recent swing low or swing high. A liquidity sweep is recognized by a candle with a long wick or body, followed by a sharp and immediate price movement that triggers a market structure shift. Looking more closely, we can see that the price has created a valid, unmitigated breaker block exactly at the location of the last buying candle. This candle formed right before a strong downward move. This breaker block meets all the criteria of an ideal setup. The price cleared sell-side liquidity, and after forming a new lower low, quickly reversed and created a market structure shift by breaking and closing above it. At this point, we can identify a valid breaker block positioned above the fair value gap. Placing an entry directly at the fair value gap might cause a missed opportunity, since the price often does not return to the gap once it moves decisively away from it. In this case, the reaction is expected to come from the breaker block rather than the fair value gap. For this reason, the entry should be placed at the highest point of the breaker block, with a stop loss positioned a few pips below the fair value gap. When planning the execution, there are two main options. The first is a single time frame entry taken directly from the current chart. The second is a more conservative approach that waits for additional confirmation. This could include looking for multiple reversal signals, such as a change of character forming on lower time frames inside the breaker block that was identified on the higher time frame. A second high-quality setup happens when a breaker block aligns with a significant liquidity void. This usually occurs when the price breaks through the breaker block with inefficiency, leaving the entire area inside a gap. This combination often produces highly reliable buy or sell opportunities. Another strong setup appears when a breaker block forms in conjunction with an order block. In this case, the order block develops near the breaker block zone. These setups are powerful because they mark areas where many orders were previously executed and where positions may still be active, increasing the probability of a retest. In this final scenario, we identify a valid breaker block paired with an order block. The entry is placed at the highest point of the breaker block, and we wait patiently for price to return and activate the trade. In conclusion, breaker blocks show how failed order blocks transform into high-probability continuation zones after liquidity is cleared and structure shifts. When aligned with liquidity sweeps, fair value gaps, or nearby order blocks, they provide structured and logical entry areas. By applying these rules with discipline, you position yourself in alignment with institutional flow. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.